Welcome to the Stock Market Palantir. Today we are going to talk about SOUN. We are diving into SoundHound AI, a name that's really captured the attention of, well, both fundamental analysts and market mechanics experts. It's a company that has, made this quick shift from what a lot of people saw as a purely speculative asset into a legitimate high-growth enterprise software provider.
The tension around this stock is it's remarkable because it really pits two very powerful forces against each other. On one side, you have this clear evidence of rapid fundamental business acceleration. We saw 68% year-over-year revenue growth in Q3 2025.
Right.
But on the other, you have these extreme market microstructure dynamics. You've got exceptionally high short interest, methodical dark pool activity, and, frankly, a valuation that is demanding historical perfection.
Exactly. And that conflict is really the core of our discussion today. So the central question is this: is the long-term investment thesis for SOUN defined by its strategic pivot to what they're calling agentic AI and its strong operational execution, or does the short-term price action and all the associated structural risks driven by these valuation premiums and, let's be honest, sophisticated institutional short selling make the stock just untenable right now?
Well, I'll be taking the position that the current level of institutional skepticism, which, you can see reflected in that extreme short interest and those sky-high valuation multiples, it all indicates structural risks and technical mechanisms that fundamentally challenge the current stock price, regardless of how good the operational improvements look on paper.
And I'm going to argue that the underlying fundamental growth, the decisive strategic M&A activities, specifically adding interactions in Amelia, and the proprietary tech moat they are building absolutely justify the current valuation. And I think they'll ultimately outweigh what I see as temporary, albeit substantial, market volatility and noise.
I'm interested to hear how you rationalize that valuation. Let's start with your core case for the long thesis, the technology.
Is absolutely rooted in technological evolution. SoundHound is moving beyond simple voice commands, which is, table stakes now, into what they call agentic AI. For anyone listening, this basically means the AI agent doesn't just do one instruction. It performs complex, multi-step workflows on its own. It's effectively solving problems. So imagine a customer service chat where the AI proactively identifies the issue, verifies the user, checks inventory, processes a return, and schedules a follow-up, all without a human. That shift is a huge force multiplier for their clients. And this momentum is really evident in the numbers. Q3 2025 results, they confirmed this scaling, $42 million in revenue, which is that confirmed 68% year-over-year jump. But critically, the recent Interactions acquisition is providing this really necessary high-margin revenue diversification. It's pulling them into critical sectors like banking, telecom, and healthcare. The major synergy here isn't just top-line revenue, it's margin expansion. The plan is to migrate those new customers and their intelligent virtual assistants, or IVAs, onto SoundHound's superior proprietary speech-to-meaning stack. And that move captures the full economic value. So management validated this by confidently raising the full-year guidance to $165 to $180 million. And even with all the M&A, the non-GAAP net loss improved by 13% year-over-year, which shows they're getting operating leverage.
Okay, I see why you think that, particularly with the revenue growth and the strategy behind the Interactions deal. However, I have to frame all this success within the context of the valuation. The market is pricing SOUN for absolute perfection. When a company is trading at 33 to 38 times trailing sales, it means the market has already factored in several years, maybe even a decade, of that flawless execution you just described. The core issue I see is one of, it's about timing and the financial environment. This valuation requires flawless, multi-year execution, yet the focus has to remain on their delayed profitability. Management has adjusted the target for positive adjusted EBITDA, which is the real measure of operational cash flow health, all the way out to 2026. In our current high interest rate environment, the market just severely penalizes growth strategies that don't have a clear immediate path to cash flow. I mean, the market just doesn't have the patience it had back in 2021. And on top of that, this stock is structurally weighted down by just overwhelming institutional skepticism. We can measure this pretty precisely with the short interest figures. We're looking at about 116.4 million shares held short. That's 30.73% of the public float. That is an exceptionally high figure. It represents a massive, sustained bet against the stock. And the high level of dark pool activity we've seen only reinforces this. On November 17th, we saw almost 45% of off-exchange volume was short sales. This suggests a persistent, methodical, and anonymous selling pressure that creates an artificial ceiling that positive news struggles to break through.
That brings us directly to the Q3 earnings, which you mentioned spooked the market. I do want to challenge the weight you're giving to that fear.
That's a necessary discussion. Look, you pointed out the stability and the non-GAAP improvement, but the massive GAAP net loss was the headline. We're talking about a negative $109.3 million loss, driven mainly by a non-cash charge of $66 million for contingent liabilities. For our listeners, because the stock price went up, SOUN had to record a huge paper expense reflecting the increasing value of liabilities tied to that price, like warrants. Sophisticated institutional investors, sure, they understand this is non-cash and shouldn't impact long-term value, but the perception matters more than the accounting reality in the short run. Retail traders, algo traders, they react violently to a triple-digit net loss headline. And that leads directly to that counterintuitive sell the news drop despite the revenue beat. I would argue that in this name, perception dictates price, and that gap number was just terrible perception management.
But I'm just not convinced by that line of reasoning because institutional capital, the money that actually dictates long-term funding, it does look past the noise and focuses on the non-GAAP metrics. They look at the stability of the non-GAAP gross margin, which held strong at 59.3%, and the operating leverage, that 13% improvement in the non-GAAP net loss. That's the true health metric of a SaaS company. It shows they're scaling sales faster than costs. The post-earnings drop was, in my view, primarily profit-taking by short-term traders, a classic buy the rumor, sell the news scenario. And it was made worse by macro headwinds. We saw inflation fears rising, and high-growth names like this are always the most sensitive to rate hikes. To suggest that a non-cash accounting adjustment, which is totally irrelevant to cash flow, fundamentally damaged the thesis. Well, that ignores the strong cash position. The company has a healthy $269 million in cash, which gives them a significant runway to execute their plan through 2026. The fundamentals are sound.
That runway is undeniably necessary. I'll give you that. But it doesn't solve the structural problem created by that persistent, aggressive short interest. We have to address that before we can even really talk about valuation.
I agree. Let's talk about that short volume because the high short interest creates a perpetual powder keg under the stock. The days to cover ratio has climbed to 3.72 days. So for the audience, this just means it would take almost 4 days for all the short sellers to buy back their shares at an average volume. A number like that signifies a really narrow exit door, so any unexpected positive catalyst like the Parkopedia news or even just a market tailwind could trigger an exponential short squeeze. This is the mechanism that could drive the price well above that current consensus target of 1728. And the retail accumulation, the diamond hands, provides a really necessary counterbalance of capital against that institutional selling.
I come at it from a different way, though, regarding the nature of that short volume. While the squeeze potential is mathematically real, we have to ask why the short volume is so high and where it's happening. You mentioned the dark pool activity, showing almost half of all off-exchange trades are shorts. This suggests to me that this is often not just directional speculation, but highly sophisticated institutional hedging. Just think about it. Large, long holders, maybe from the SPAC or acquisitions, they might have lockups or just big, concentrated positions. They can use short positions in the dark pool to cap their upside risk or just manage volatility. This strategy creates a reliable, high-volume price ceiling that dampens the effect of retail buying. And furthermore, we have to look at the high fails to deliver. Over 500,000 shares failed to settle on October 31st. FTDs are often a sign of aggressive liquidity management by institutions. So help me understand why you believe retail buying can overcome the fundamental mechanical reality that the institutional side is actively using market structure
dark pools, FTDs, to control the price ceiling. Regardless of whether the news is good, the market is structured to absorb that pressure.
That is a critical point about the mechanics, but it assumes this hedging is a permanent condition. Hedging strategies eventually unwind. And if institutional players are hedging, it implies they have a core long position they want to protect. It actually validates the long-term enterprise value. If they really believed the stock was worthless, they would just sell the shares, not engage in complex, costly hedging. We have to move this beyond the short-term trading and focus on the strategic moat that makes this stock compelling enough for them to hold in the first place. The recent Parkopedia partnership is a crucial element here. It fundamentally changes SoundHound's revenue model. It moves them from a pure licensing model, a one-time fee per car, to a transactional model, where they take a revenue share on parking payments made through their AI. This massively increases the total addressable market, or TAM, per vehicle over the lifetime of the car and provides recurring revenue. That is a game changer for revenue quality. This momentum, plus the continued validation from the NVIDIA strategic investment, that clear NVIDIA halo effect, it all validates the long-term thesis that SoundHound's technological neutrality is its moat. SoundHound is the only viable independent alternative for major car OEMs who will never, ever cede their customer data to the massive ecosystems of Apple or Google. Their independence is the core competitive advantage.
That's a compelling argument on the neutrality defense and the shift to transactional revenue. But have you sufficiently factored in the technological and cultural integration risk in all of this aggressive M&A? You mentioned the plan to migrate thousands of legacy IVAs from Interactions and Amelia onto their proprietary stack. That migration is not a simple software update. It is technologically and culturally complex. You are moving live systems that handle critical customer interactions, banking, healthcare, onto a new architecture. If they fail to execute that flawlessly, it could lead to significant customer churn and margin degradation. And given the stock is priced at 33 times sales, the market will punish that kind of failure instantly and severely. We've seen so many tech roll-ups fail on integration, and SoundHound has taken on a substantial load here. And while the neutrality defense is strong, the threat from those ever-improving big tech voice assistants is always there, especially as they integrate better LLMs. Finally, that aggressive M&A strategy you cite as a strength has resulted in continued equity dilution. This constant increase in the share count will inevitably cap the stock price upside, even if the market cap grows, because the value is spread across more shares. That's a continuous headwind.
That integration risk is a necessary hurdle in any growth by acquisition strategy, sure. But the fact that management raised guidance after the Interactions deal closed strongly suggests they are managing that integration effectively. They're seeing early returns, not failures. They would not risk raising guidance if customer churn was a real immediate threat.
Well, we'll have to wait for the successful completion of those migration milestones to truly validate that. They still have a long way to go to earn that 33 times multiple. So, to summarize my position, I maintain that SoundHound AI, despite genuine and impressive progress, is currently a stock where market structure dictates the price far more than its projected long-term fundamentals. Investors have to recognize they are buying into a high-beta battleground defined by an extreme valuation and persistent, sophisticated short-selling pressure. And the execution risk remains paramount given that profitability target is still 2 years away.
And while I fully acknowledge the microstructure volatility and the concerns around dilution, the long-term thesis hinges entirely on SoundHound's ability to capitalize on the boom in agentic AI. The company has successfully navigated the post-SPAC era and established itself as a legitimate high-growth entity with a unique technological moat. If SOUN executes on its shift to a transactional revenue model validated by that Parkopedia deal and realizes the margin opportunities from its acquisitions, its current price target consensus of 17 plus will likely prove conservative.
So the material we reviewed really shows that SOUN is no longer just a meme stock. It's a deeply complex, high-risk, high-reward bet on the future of conversational AI, and it requires investors to weigh that operational potential against some pretty serious institutional skepticism and the raw mechanics of the stock market itself.
Right. So to summarize our discussion on SOUN, we've really analyzed the conflicting forces of strong revenue growth and strategic acquisitions set against an exceptionally aggressive short interest and demanding valuation multiples.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.